Here we're looking at dojis. You'll notice that there is no real body. What we're seeing in a doji is evidence of indecision. The market, and again, we'll stick with the theme of daily charts. In this case, the open and the close are the exact same price or pretty much near the exact same price, maybe a couple of pennies off. And what the doji is saying that in the middle of the day, the market rallied and sold off, but closed basically where it opened. This is evidence of indecision. We often see these dojis at turning points. Sometimes the dojis don't close near the open in the middle of the trading period. In some cases, the wicks are substantially longer than normal candlesticks. And what this is evidence of reversal. We definitely see these at the end of trends, suggesting that something is changing. So there's two types of dojis that I want to focus on. One of them is the dragonfly doji, where the opening and the close, of course, is right around the same level at the highs of the day. But in the middle of the day, the market sold off dramatically, only to return and close where it originally opened. When you see something like that in a downtrend, in all likelihood, something is probably changing. That is a bullish indicator. That is a heads up that maybe we should be covering some shorts. Maybe we should be putting on new long positions, but definitely a reversal candlestick within a downtrend for sure. A gravestone doji is the opposite. This is something that we're looking for in uptrends as evidence of a reversal or a change in that uptrend. So the gravestone doji in this case obviously closed right near the open, as is the case with every type of doji, but in the middle of the day rallied dramatically only to sell off and go out at the lows of the day. When you see a candlestick like this showing up in a strong uptrend, in all likelihood, that trend is getting exhausted. The sellers are starting to take control, even if it's just a short term. So when you see these sorts of doji candlesticks, it doesn't necessarily mean that the market is going to reverse, but in all likelihood, the market, the trend in that market is probably changing. Maybe from an uptrend to a sideways trend, maybe from a downtrend to a sideways trend, but that indecision is something that we want to look for. So let's take a look at a few examples of these candlesticks. I think this is a great one. We are looking at a huge base in the Dow Jones Transportation Average. And as it's breaking above resistance, which we're going to discuss in a later module, you have a nice green hollow candlestick, a bullish development coming out of a major base. We take this as evidence that the buyers are in control, not the sellers. Here, we are looking at a bullish reversal candlestick. Okay, these are the lows in U.S. interest rates in the summer of 2012. This was key support. And you could see a nice big green hollow candlestick really opening below the close from the previous day and closing substantially above it. That sort of reversal pattern is something that we want to look for. Here's the opposite. This is a bearish reversal candle. This is the Russell 2000 in 2008. The market gapped up substantially above resistance to make a new all-time high in the Russell 2000 small cap. Okay, this is in the early fall of 2008. But notice how on an intraday basis, you could see the candlestick. Look at the long wick, the shadow, and notice the massive reversal. And because it's a filled candlestick, that is suggesting to us that the market is closing substantially below where it opened. So not only are we closing way below the opening price, but way below the high of the day, and it could not hold the all-time high, that bearish indication led to a massive crash. And if you were looking at the types of candlestick, I would argue you would have a huge advantage over those who were unaware at the time.